Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back. This is episode 185 of Upticks, March Market Update. Cory, welcome back to the show. It's been a while.
It has been a while. Thanks for having me.
You know, it's been fun having a variety of guests on the show, and hopefully our audience at Falcon Wealth Advisors Collective are enjoying it. I know you've been having some guests on. I've been having some guests on. So again, the best way to make sure that you don't miss an episode of Upticks or Cory's show, In the Money Insight, is to subscribe, like, share our content. We also email it out every Tuesday morning. So if you go to falconwealthadvisors.com, you can subscribe to our email newsletter. We will not spam you. That is a promise, right, Cory?
That's right.
We're not spamming people, and we're not selling your email either to some marketing company, right? We're just emailing we're emailing our content to you. So again, thank you for tuning in. But for today's topic, you and I wanted to talk about a March market update. Can't believe spring is already hopefully in the air in Kansas City. It's kind of a roller coaster winter, wouldn't you say?
Yes, it has been. It's winter in the Midwest.
You know, and I shut it down for golf. I don't really try to squeeze in rounds here or there because the greens are frozen and, you know, the grass isn't green. So I just stay away. Have you been playing any tennis outdoors when the weather was nice, or do you kind of same mentality? You don't play outdoor. I know you do paddle, which is different. That's designed to be in cold weather. But did you play any tennis this winter outside?
Not outside.
Yeah.
I'll play paddle outside or tennis in the bubble, but no tennis outside.
Right. But in the summer, you play tennis outside.
Mm-hmm.
Right. So yeah.
I'm sure there's been some people out there on the courts in the nice, just like we've seen people on the golf course.
Absolutely. Yeah. It's just, for me, it doesn't work. It's either golf season or not. So
yeah, I hear you.
Anyway, so spring hopefully is in the air. So regarding the market, we've had a very turbulent start to 2022. And now Russia and Ukraine are at war, which is horrible for humanity. Obviously, we don't like seeing conflict, regardless of what place on the earth it is. But, you know, Cory, we've been having a lot of questions with clients, and I think it's fascinating how quickly people can forget that, you know, during the pandemic, the market had 2 amazing years despite a global, horrible health crisis, right? And during that time, the market crashed 30% and still managed to finish up the year that it did that. And then in 2021, it had another above average return. And so now that the waters have rippled a little bit and the market is negative, we're starting to get some of it's usually new clients, which is fascinating to me. It's usually new clients that are panicking a little bit. And again, our job at Falcon Wealth Advisors is to help people or prevent them from making horrible mistakes and talking them off the ledge and bringing them back on. So why don't you give your perspective a little bit? And then I've got pulled up here on my other screen, I've got some really interesting facts about what's happened when we've had geopolitical disruption. But Cory, what are some of your thoughts? That's kind of my take on it, but what are you thinking?
No, I agree with most everything that pretty much everything you did just say. I do think what is interesting and unique about the conflict in Russia and the Ukraine, and I say interesting and unique, I just mean from a market's perspective, that we've seen this occur simultaneously while we've seen interest rates start to rise. There's been an ongoing discussion about how the Federal Reserve is going to handle inflation, how they're going to handle interest rates, and then a geopolitical shock like this, it happens at the same time. So, and I have noticed and observed over the years that it seems like when things are going well, there has a tendency to be good headlines. And when things are going poorly, it just seems like there's one bad headline after the next in the news flow. It feels horrible. It just feels like something is, terribly wrong. And there is a lot of things wrong with war, frankly. But that's not as much as, what we're talking about here today. It's more of a focus on, the markets and the impact. But the fact that there have been, two major issues, and we expected the Fed, inflation, interest rates, the upcoming election, we expected those to cause some volatile events. But there's always the unexpected events like this particular conflict. So now that we've seen this start to play out, what I have found interesting too is, the market often panics, right, in advance of those types of events or when those things are on the horizon. And then once the event actually plays out is when we start to see things bounce and turn the other way. And it doesn't mean that that's going to be exactly what happens.
Let me interrupt you
there. Go ahead.
So what's interesting about that is the day that the news broke out that Russia and Ukraine were at war, the market was down severely in the morning. And even in that same day, it turned around and finished higher. So that's what's crazy. So I had a phone call with a new client, and I get it, right? She's nervous.
Sure.
There's nothing wrong with that, by the way. There's nothing wrong with being nervous, but she wanted to sell everything. And I said, well, let's hold on here a little bit. And if anything, if the market goes down enough, we're actually going to buy. We're not going to sell. We're going to buy more of it because companies in our portfolio, we have a lot of conviction. And just because there's a war going on the other side of the earth doesn't mean that they're going to go out of business. And that's what you need to kind of gain perspective on. And so, and I didn't call her because I didn't want to rub it in her face, but I mean, the market literally that quickly went down and went up same day. Now that doesn't mean it's going to keep doing that, right? But it can get turbulent. And I think for today's show, pro tip number one is you don't want to have anything in the stock market that you're going to need in the next week, month, even year, right? You want to have money in the stock market that is designed to grow your investments, to your point, Cory, faster than inflation, faster than your spending goes up. That's why we use stocks. That's why we invest in companies. We don't invest in stocks because we're trying to turn a profit in a day or a week or a month. And frankly, we don't care if they go down. We don't like it, but it doesn't impact our clients' financial plans. It's just like, and a good way to think of this is your house, Cory, goes up and down in value every day, but you're not trying to sell your house. So it doesn't matter what it's worth today. And that's, I almost wish sometimes that people that have a tendency to panic, because the poor lady was losing sleep at night. I don't like that. I don't want that, right? But it almost would be better for her if she didn't know what the value of her stocks were, right? Even though that goes against what we do, because we want transparency and we want clients to be able to know that. And all of our clients can pull it up at any minute and see what their portfolio is valued at based on if the market's open or not. But for her, it would have been better for her just to see you have this many stocks and, not show her what the value is, because again, we don't need to sell those stocks. So it didn't matter what those values were. And I know I cut you off there because I didn't want to go down kind of into a rabbit hole with that. But what else were you going to say regarding it? But I just wanted to make it clear that because things get turbulent, you don't have to. So again, pro tip is you don't want to have anything in the stock market that you're going to need today.
Yes. And I think this conflict that we have seen in this market turbulence, Jake, in 2022 is a firm reminder of why that is, because we talk about that all the time, right? On this show, on conversations that we have with clients about how we don't want to have short-term money invested in stocks. This is a perfect example why. But part of our job is to help our clients, understand what their financial plan means to them and help them understand whether they're working and accumulating or they're retired and spending, help them understand where the cash flow is coming from, what bucket of funds are available that are not at risk like the equities in their portfolio are. And it's all set up by design. And the last point that I'll add to that, Jake, is that I do think in working with a fiduciary and with an advisor, so clients know, we understand that the market will get volatile and that bad things will happen. And I think it's important for someone, if they have entrusted someone to handle the financial planning and investment management for them and their families, it's important for them to know that whomever they've hired, whether it's Falcon Wealth Advisors or someone else, a portfolio design and construction should be made understanding that bad things will happen, as opposed to if we invested clients' assets never expecting anything bad to occur. That's part of the design, is that these things happen, and we want to be as opportunistic as we can and take advantage of them when they present themselves.
Right, exactly. And so that's why again, like I mentioned, we're not surprised when these events, and there's going to be something else, and there's going to be something else after that, and there's going to be something else after that. And I think it's just important to, like you said, that we have all of that built into our clients' financial plans. And we don't take it personally when clients want to sell out of the market. But frankly, though, if that's something that you want to do, you shouldn't be paying us to do that. In fact, we will resign the account, because if a client's going to call in and say, I'm scared, get me all out of stocks, they're basically blowing up their financial plan. And I don't feel comfortable charging, frankly, right, a client if they're not going to take our advice. What are we doing then? And so, you know, I don't mean that in a negative way, but, you know, again,
Right.
clients are hiring us because they trust us. And, you know, it's fine to call in and get an explanation. It's fine to have a conversation and meet and go over it and look at your financial plan. Yes, I want to do all that. But I just think, you know, ultimately, if clients want to drive the investments, then they should drive the investments. They shouldn't hire an advisor, period. Because ultimately, they're paying us to navigate that. Now, again, we also can't control the market, though. So that's what they have to understand, that their accounts are going to be down sometimes, right? And their accounts hopefully are going to be up more often than they're down. And that's what we have built into the plans. And the short-term money is in cash or in bonds, right? And that's, especially for a retiree, that's money. And we like to leave at least 5 years worth of income in that bucket that you mentioned. So that, again, what the stocks do today doesn't matter. And they should be really concerned, what is their stock portfolio going to look like 5 years from now, or 10 years from now, or 20 years from now? And again, that gets even harder to predict, because nobody knows, right? So thank you for that. That's a good explanation. So let's unwrap, though, a little bit about what's going on with the geopolitical environment. I do have a fun one here. I'll kick us off with some of these facts. And credit to Hightower, they sent out some internal communication last night. Now, here's the problem with looking at the facts, though, is that there's no guarantee that this is how it's going to look in the future, right? So past results aren't indicative of future results, but it's good to know that they put out a blurb here that if we go back to World War II, Cory, markets, and then you look at all the geopolitical disruptions, markets were up 2/3 of the time a month later, and 83% of the time a year later. And again, I guess you could consider the pandemic a geopolitical event, but maybe not. I guess it's more of a health issue. But you can look at that, at how quickly the markets recovered from that alone. So, and every time, this time is different. Well, I would argue the pandemic was way different.
It's always different. Yeah.
And sadly, war isn't different. As long as there's humans on Earth, there's going to be war. I'm convinced, but maybe, hopefully not. But what are your thoughts on that? And do you have another fact to share?
Yeah, you're absolutely right about all of that. And I do think it's interesting to point out, just thinking over the last 5 or 6 years, we've now had this conflict, and we'll see how this plays out 6-12 months from now. We had the pandemic in 2020. We had, you know, and I think a lot of us have forgotten about this, or it's a distant memory at this point, but the night that President Trump was elected in 2020, the market basically hit its limit down in overnight trading. The market dropped 7% overnight. And then we know how that story ended. And Brexit's another example from the same year, 2016. Those are 4 examples of, you know, these major events that have played out since 2016. And we know what the market has done over that time frame. The point there being, and I think, Jake, the data supports this too, that, you know, when there is a geopolitical shock like this, looking into the future, whether or not the country and the economy heads into a recession is a much larger indicator of the direction that the market goes, not whatever, you know, event is actually playing out.
Right. Yeah, very good point. And so that's just something to be aware of. And we're looking more at those types of things, at GDP or earnings, obviously, right? Those are really big pieces of data. And again, even if a recession were to occur, we're still not going to sell stocks. I mean, we're not. But I want clients to know that, you know, us at Falcon Wealth Advisors, we're also not sitting on our hands. We are trading those stocks. So we won't hesitate to buy or sell if we feel a stock is at risk of going out. Like, we're not saying that we're not doing that, but we're not, if you've got half of your portfolio in stocks and half in bonds, What I am saying we're not going to do is sell that half that's in stocks, all of it. We're not going to do that, but we are going to manage it within those stocks. So again, I'd say pro tip number 2 today, Cory, would be don't let your emotions dictate your investments decisions, right? So it's okay to be emotional. Emotions are good, and I want you to embrace them, but I don't want you making serious financial decisions based on fear. Just like I don't want you making serious financial decisions based on greed, right? So I love emotion. If we didn't have emotions, Cory, humanity would be really boring, wouldn't it?
Sure.
Even the bad emotions. I mean, they're chemical reactions in your brain that send us signals of how we're feeling, and we can respond accordingly. But I don't want you to react to an emotion just because you're freaking out. I mean, that's why you hire an advisor, frankly, is that way you have somebody that's going to look at the facts, bring the financial plan back into consideration, and understand those things, right? So I guess pro tip number 2 is don't act on your emotions. It's frankly silly. It's just like the good example that I've been taught is that, and I think you and I have talked about this before, Cory, but has someone ever cut you off in a traffic or just been driving like a complete idiot? And, you want to honk your horn at them. You're probably not going to flip them off. Maybe you would, Cory, but I doubt that. I don't see you doing that.
Maybe it depends on what they did. I'm just kidding.
But if you do, let's say you do give them a little honk on the horn, right? Because you're like, hey, you're acting like a dummy. Don't you kind of feel embarrassed after doing that sometimes? So again, that'd be an example of there's this external stimulus that's upsetting you. It triggers an emotional response, and then you react to it, and then you're like, well, I probably shouldn't have done that, right? So that's a small example, but a big example would be, well, I hate this Russia and Ukraine war, Cory. I'm gonna call up my advisor. I'm gonna tell him to get me out of the market. Well, now are you gonna have to go back to work? Are you gonna run out of money? Now, I mean, this is a serious decision you're making, because you're disrupting hours and hours and hours of work that we've put in to building a financial plan for you. And if you're just saying, I'm going to wash all that away, I'm going to swipe all that away, well then, I mean, you're basically going completely against the grain of because the plan says stay invested. Now the plan wants you to be invested smartly, but it doesn't say, our plans don't say get out when Russia goes to war with Ukraine. That's not in the plan.
Exactly. And I have a few quick things to add to that.
Thank you.
One is, the way that I think about this and process it, whatever night it was, a couple of nights ago when we saw the news hit that Russia was, crossing into Ukraine and that they were going to start attacking the Ukraine, just like I'm sure most other people process that. When I read that and saw what was happening, it's scary, right? It's a scary thing. And I think that too. It doesn't mean that I look at that and have no emotion toward it. I look at that and say, that is scary. It is horrible. It's a humanitarian crisis. I mean, a war is one of the things that we want to avoid at all costs, wherever we can, whenever we can. But I also start naturally, because of what we do, right? I then go look at the market, see what the futures market's doing, see how it's reacting. And I think, okay, that's scary too, right? You start seeing the market sell off because of what's going on, but then you process some of those emotions and think, well, wait a minute. In my personal financial plan and in the financial plan for all of the clients that we work with, nowhere in there does our investment policy statement say if the market drops 15% due to a geopolitical conflict, we're going to sell everyone's stocks, right? That's not part of the plan. In fact, the plan has been built with volatility in mind, that these events will happen and it will happen again. And I don't even know, I have no idea what it will be, but it will inevitably happen again. And I think it's good for people this is a good time for a little bit of reflection after we've seen this happen, is to process this, understand how we feel about it, to hopefully help us the next time something like this occurs. So that is, that's a very important part in all of this. And I do think it's kind of a sidebar, but along the same lines, we talk about this, Jake, you and I do a lot, and there's a lot of talk in the financial services community, and sometimes even on a more broad stage than that, about, the way that people work with advisors, the way that people pay advisors, how much money people pay, how they can reduce their fees. And I think all of that is good and valid information for people to understand. I also think in moments like this one, what I have learned over the years is that as an advisor to clients, as someone who is, responsible for helping them plan for the future and allocating their capital, that, an advisor can really earn a lifetime of fees if they can help prevent a client from blowing themselves up in an emotional moment.
Right. That's a really good point. And thinking about all that, that leads me to pro tip number 3 for today's show is that, and I've been posting this on social media because people forget it, is to buy low and sell high. And that includes during wars, and that includes during pandemics. Those things aren't excluded from that concept. It's so funny because you're right, Cory, that we don't have in our investment policy statement that, because people will ask that, well, when is, how low are you going to let my stocks go before you're going to sell them? And my answer is I'm not. Like, zero. Like, and I really don't think that will happen the way that we invest money, that all of your investments are going to go to zero. It could happen, obviously, but we're going to buy when they drop. And the retiree, I think the retiree makes an excuse for themselves because they say, well, I don't work, I don't have time, I need this money to last. And they're 100% right. That's why you have bonds and cash in a portfolio. That's why it's there. And again, at a minimum 5 years, ideally 10 years. But we take those bonds in cash, because what happens is if your stocks go down, well, now your bonds and cash become overweight. So we just peel from those and we go and buy stocks with it, right? And that is proven over time to be, a far better way of investing than timing the market, right? Because people, frankly, can't time the market. You can't guess when to get in and when to get out. And if your account dips down 20%, I obviously don't like to see that. But selling at that point is the absolute wrong thing to do. You are making permanent damage to a portfolio. That money is gone, it is locked in, and you will not get it back unless you reinvest. And oftentimes when people do that, they reinvest when it's already back up. Well, then now you've cost you and your family thousands and thousands and thousands of dollars by just doing something that you quote unquote thought was smart. And so again, you have to think about it. Like it's easy to think about it this way, Cory, when your emotions aren't involved, of course. And that's, again, like you said, that's where we earn our cost of admission by talking clients off of this ledge. Like, let's take a step back here. You're doing the opposite of what you want to do, the opposite of what you should be doing. Warren Buffett famously said, right, one of his quotes is, doesn't he say, buy when there's blood in the streets? Isn't that one of his deals? Or buy when others are fearful and sell when others are greedy. I mean, you're talking about one of the best investors in the history of mankind says that. Buy when there's blood, which is a very vulgar statement. Buy when there's blood in the streets, Cory.
Yeah, and his counterpart, Charlie Munger, I also read. I read something good from Charlie Munger this week. It was a quote from, I don't know when he said it, but he mentioned that if you're going to be an investor in the markets, that the expectation should be that periodically there's going to be huge shocks to the system, and that the best thing that people can learn to do if they're invested in the markets is to learn how to deal with that. And he's right. Right? How do you live with that? How do you deal with that? And everything we're talking about here today, we have the expectation that these things are going to occur. It's not ever fun when they do, but it's not as if, we're caught here with our hands on our heads saying, oh my gosh, now what? What are we supposed to do? We didn't think the market could get volatile to the downside, right? It seems kind of silly when we put it that way. But yes, that's exactly right. And, I do think that everything that we're talking about here today and what you just described, Jake, about Warren Buffett and applying a strategy and sticking to a plan that is designed to help you accomplish your goals is what is most important. And there's always going to be something that could disrupt that or make you want to do something different, but you go through the process and the work of putting together a plan and defining goals so you don't have to panic when something occurs.
Right. And so I think the argument, though, against your statement, which would be, well, Cory, if I don't like the swings in the market, maybe I shouldn't be invested in the market. And so my answer to that thought would be, maybe you shouldn't be in the market, but most importantly, can your financial plan afford you not to be in the market? Because if you're not going to be in the market, then we need to figure out where are you going to put your money so that it will outlast you, right? Because that's the whole reason. Because I assure you, if there was a better way of investing that you didn't have to have this type of risk or volatility, we'd be doing it, right? But we like the stock market because it's liquid. You can buy and sell on most any business day. Historically, over time, it has beaten inflation, right? And there's a lot of transparency there. These companies that we're investing in have to report their earnings and have to open up their books. And we like that transparency, as opposed to maybe private equity or other things maybe don't have to do that, right? And so again, if you don't think you can stomach the swings, that's okay. But then you need to recognize that, okay, if your assets aren't going to grow, do you have enough money piled up so that it won't outlast, you won't outlast your money, and meaning you won't run out of money is basically what I'm getting at. So that's, again, something to be cognizant of. I want to throw out a couple more facts here. So according to JP Morgan, historically, 6 of the 10 best days in the market occur within 2 weeks of the 10 worst days. All right, which is a lot, but that's another point of why you shouldn't be getting out when you have a really bad day. Normally, that you get this bounce back, right? And so if you say, "Oh my gosh, Cory, the market's down 5% today, I'm freaking out, just get me out." Well, the reason we really try to talk people off the ledge of doing that is because we want them to experience the recoil and the bounce back. You don't want to miss that. I mean, you've already ridden the ship down. Let's ride it back up, because it's going to do this. And so you don't want to panic sell of that. That's what, according to JP Morgan, that's not for me. And again, it's no predictor of the future. We're just saying that historically speaking, that's what's happened. And again, every time is different. Every time is new.
Exactly. And the companies that are involved in whatever the shock is, that's what's so fascinating, to your point earlier about humans, right? The human condition, in a way, is that, most of what we have seen when these types of events occur, they have occurred, they'll continue to occur. The names and the people and the actors involved change, but human response to it remains the same. And, I read what I thought was interesting or funny, that the day following Russia crossing the border into Ukraine, when the market was down big in the morning, and then it rallied hard towards the end of the day. And someone was trying to explain why that happened. And someone said the best explanation is that the market gods were punishing the people that panic sold in the morning.
Huh. Interesting. Which that probably wasn't the case, but
I just mean for some perspective, like what we're talking about here, people look at that and say, well, what in the world? Like the NASDAQ that particular day was down 2 or 3%, and it closed up over 3%, which is a 5+% reversal in a single trading session, in a single day.
That's crazy.
And if it's a lot that could, depending upon the dollars, that could make a huge difference. And we've seen this play out in real time, and we don't know where things go from here, but that one particular day is a perfect example of exactly what we're talking about. Because getting out is easy, getting back in is the hard part, in my opinion. Because when do you get back in? Now that the market's bounced, if you freaked out and sold everything when it was down and it's bounced, now you either have the choice to reinvest at a higher price or wait for it to decline back to where you sold, which may or may not happen.
Right. Really good point. Do you want to throw out another quick fact? I know we got to wind up here today. Do you have another one for the show?
Yes, back to this came from elsewhere. I think it was actually LPL Research is where I saw this. That, again, going back to probably some of the similar data that JP Morgan reported, that broadly speaking, going back the last several decades, these geopolitical events have been followed by an almost 11% return in the market a year later, with the caveat being unless the country has gone into a recession, which, again, my point is that just goes to show us that obviously the country going into recession is going to have an impact on the market regardless of any geopolitical events. But any geopolitical events don't have as much of an impact down the road unless the country goes into a recession, if I explain that well.
Yeah, I mean, that's a good point. So you just have to, again, zoom out, put things in perspective. Remember our pro tips, right? Shouldn't have anything in the market that you need today. You want to buy low, sell high. Don't throw your financial plan out the water based on emotions, right? Think about all of those things. Don't hesitate. Email me, call me, text me. That's what we're here for. We're always going to go back to the facts. We're always going to pull up your financial plan. We're going to look at those things and we're going to discuss them. Cory, you and I have a team. There's 12 of us. So again, if you and I are in a meeting or aren't available, there's other members of our team here to assist and talk about it. But yeah, thank you for joining me on the show today, Cory. Do you have any fun stuff? Do you have any shows, books, movies, anything going on in your life? You found out what your dog was. I saw.
Oh, yes.
So
Yes.
I know you adopted your dog or rescued him, right? So what is you did a DNA test on your dog?
Yeah.
What'd that cost you? What'd that run you?
$150.
Wow, that's a lot of money, isn't it?
I resisted it for 2 years. I finally said, okay, all right, we're going to do this. And now for what it's worth, if people are interested, you can buy a DNA test that the same company that makes these. There's one you can buy for $100 that will tell you the ancestry and the breed. There's one that you can buy for $150 that will do a whole lot of health testing on your dog to help you understand what type of potential health concerns, that breed.
Do you really believe all that?
I don't know. I mean, it could all just be made up. I don't think it is.
Did he lick something?
No, we actually, I swabbed the inside of his jowls or of his cheeks. So I swabbed it for like 60 seconds, put the swab in a little container and mailed it off.
So what kind of dog do you have? Is he a poodle?
We were a little bit surprised to find out. The most predominant breed, which is about 30%, is German Shepherd, which I thought was a possibility. But interestingly, American Pit Bull was the next closest, followed by Shih Tzu, which was very surprising to both Cassie and I, and Boxer. And then, of course, they classify 18% of his genetic makeup is what they call a super mutt, which means basically one of his parents was a mixed breed dog that may have had mixed breed parents. So there's all kinds of trace things that are found, but ultimately there's no way to draw the line back.
I will flash up a picture of Otis here because he doesn't look like a German Shepherd. I guess he does in the face a little, right?
Yep. We were shocked that there was no Basset Hound because his body and his paws, and we've convinced ourselves that is what his predominant breed was, and that showed up nowhere in the test.
Now, did you send a picture with the test?
I uploaded a picture to the website.
See, I think those people were cheating a little bit because they can see I would love to do the swab without a picture and see what they come back with.
You could absolutely do that. And for what it's worth, I uploaded the picture after I sent the swab off.
Yeah, but they probably got the swab and then looked at the picture, don't you think?
No, because the reason I say that, and the last point I'll make on this is that what I haven't been clear on is I told Cassie this last night when we found out. I said, I have been, for what it's worth, thoroughly impressed with this product. Like basically from start to finish, the way that they've communicated and the full report that they put together, it's pretty amazing. Like they traced the maternal and paternal ancestry back to like Central Asia 15,000 years ago. And they do all this through testing the dog, the genome, and then they do this genetic testing on the dog to learn more about it. It's pretty interesting.
Yeah, good for you guys. That's pretty cool. So we'll make sure Otis's debut here on Upticks.
What's fun in your life?
I'm reading a really good book by Wim Hof, who's this who's kind of this like holistic health guy. I think it's very fascinating, actually. It's about his life and his method. I think I'm about halfway through. I'm reading this one pretty quickly, but I do recommend it. He talks about these deep breathing techniques and the cold. This guy would jump in this pond that was iced over, and supposedly it's really good for you. So, and then he does like a mindfulness, I think, meditation. So pretty cool stuff. I'm really fascinated by it. A good friend of mine, John, had introduced me to his method years ago, the breathing technique. So I picked up his book and just wanted to learn more about the method itself. So that's a pretty cool book. I'm finishing up that. But yeah, not much else going on. I'm ready for spring. I mean, Kansas City is still cold and snow on the ground as of recording this. Hopefully when this rolls out in March, brighter skies are ahead. But again, I know we gotta cut it here, Cory, but thank you again for joining me. We hope all of you out there are staying safe and healthy, and we look forward to kicking out more shows. If you've got any feedback for me, send me an email at jake@falconwealthadvisors.com. Cory, if you want to flash up your email as well.
Yeah, it's Cory@falconwealthadvisors.com. And like you said, Jake, we have a team of people here to help.
Yeah, perfect. Thank you again, and we hope all of you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.